Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
And the two key risks right now for China, and really for the global economy, these are not just Chinese risks. These are risks for everybody in the world because, as you know, if China falls off the cliff if China has a growth accident, China has a credit crisis, every major market will be hit very, very hard because they're the driver. We're looking to them to pull the wagon in here. But the reality is they can't pull the wagon yet by themselves unless U.S. demand stays intact and actually starts to grow given the capacity that they've created. So the risk is U.S. demand from the U.S. consumer getting back in the game and this credit bubble that we see them in. The reason the risk is there is because of this idea of overconsumption versus overproduction, the whole global rebalancing theme. China's massive amount of overproduction, massive amount of capacity. The U.S. was the overconsumer in the world. So this is starting to rebalance, and this whole credit crunch thing really was the point in which those imbalances in the world got so great, and the system was only allowed to suck up so much credit. There was a finite amount of sucking up of derivatives created, trillions of dollars derivative available, and the system finally broke. And this is the process of global rebalancing, as painful as it is. And what's very, very fascinating to me is even all these Keynesian economists that want to try and stop this global imbalancing through all government stimulus, where you could probably go back and read their pieces before the credit crunch saying, oh, there's the danger in the world is the global imbalances. We need to rebalance the globe. Well, it's starting to take place, and they're doing everything to try and stop it. But ultimately, we think the market will win and grind and grind and grind as overall debt in the world overwhelms even the governments. So we're seeing that, and this global rebalancing really has exposed China for their core weakness, which is lack of in-country demand. What's interesting, if you look at this whole idea of global rebalancing and U.S. as the poster child for overconsumption, China for overproduction, you see the same process within the European economies. If you think of the Eurozone as its own little system, microcosm, they're in the process of global rebalancing. Germany is the overproduction side. The overconsumption side are those southern tier states, the pigs, Portugal, Italy, Greece, and Spain. So the same rebalancing has taken place there, and that's been the crisis that's going on in Europe right now, and other things. We never thought the euro was going to be a challenger to the U.S. The core problem for the euro and the eurozone is, and nothing new here, is that it was never a fertile ground for a common currency. You have to have two criteria for a common currency. Well, several, but let's say three criteria, and two go together. Number one, you have to have some type of political cohesion. There's none of that in Europe. The different countries still hate each other. There's still warring tribes ultimately throughout Europe, formed into states that have many, many animosities across the board. When things are going well, you kind of paper over that, but when things start to get a little dicey, as you're seeing now, these hatreds come to the fore. So it was never a common political zone, which is requirement number one. Requirement number two is you have to have synchronized business cycles or fairly standardized labor productivity areas, and you don't have that in Europe. What you have is fairly unsynchronized business cycles, and the reason that's important is because if you have a one-size-fits-all monetary policy, it doesn't fit everybody when they're not in sync economically. And number two, the labor productivity, massive differences in labor productivity, and they assumed that when they would allow these southern tier states to borrow at such low rates, they would use that money to enhance labor productivity. Of course, they didn't. They just spent it on German goods, buying the overproduction side and the overconsuming side. So the labor productivity problem actually got worse, and German labor productivity rates are massively better than the other countries. France to the same degree as Germany, but to a lesser degree. And that is the core of the problem. And ultimately, even if they hold the euro together, we just see the system, in terms from a system standpoint, grinding lower on a relative growth standpoint for many years, and even worse than the U.S. And that's why long term we think the entire eurozone area currencies are the currencies we want to be short against any other block of currencies in the world. China stimulus, and here's where the rub comes, and here's where part of the concern is on China. And we say this, and we've said it with more confidence before, and I say it with less confidence now, because when we've bet on an accident in China, we've been wrong. You tend to lose a lot of money if you bet against China, because they seem to have the ability to keep the music playing. So, and they may, but they may in this cycle, and it looks like they are. But here's the rub, and here's the danger with China, because of the fact that global demand went away. If you look at the top of this chart, they had to stimulate their economy explicitly and implicitly. The Chinese government had to become the major demand factor because the U.S. fell out of as the driver. We all are cutting, and this continues, and that's why you see the improvements in the U.S. current account. People are saving more, spending less. When we save more as a U.S. consumer and spend less, it means we're buying less Chinese goods. China has massive overcapacity on exports, so they need somebody to take that demand. If you think of global macro, you push on one area, there's a counter reaction in some area. So when the U.S., who is the major driver of demand in the world, the U.S. consumer, the U.S. is over 70% of the U.S. economy, of a $14 trillion economy. So you think of that, what's that, seven? That's like almost $10 trillion of consumer demand from the U.S., much of that for imports, which are Chinese exports. And we start, and our savings rate goes from 0, up to 5-6%. That's a massive amount of demand coming out of the system from China. At the same time, which they've made massive infrastructure build, and they need more demand to clear the market there. So the credit crunch changed that game. China had to step in and be their own driver of stimulus, and they pumped, probably up to, estimates are $2 trillion, probably maybe less in the last 16 months into their economy. Over half the nominal value of their economy they've pumped in terms of stimulus, and they've met their GDP numbers. But what happens is it's created bubbles, and we created this chart, John Ross and I, my son who works for me, we do research stuff, and here's what the rub is, and here's where the real problem is, in that because China has made so much investment in capacity, and they're still on an export model, they're creating a lot of trade friction in the world. They create trade friction because basically their companies have seamless zero cost of capital. If a major Chinese company can't pay back a loan, and it's a key government-owned sector, so what? It's not like the West. So they're going to continue to pump out these very low final good prices and exports, and crush global competitors. And it's creating trade frictions, especially in the West, as I said, and I talked about with them earlier on, is as we see the swing back to labor, you see the political tension. Even if everything else being equal, this swing, think of a pendulum swing in the West from capital back to labor. Not making a value judgment here on that, but seeing that, assuming everything being equal, you would see more trade friction in general.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.